Everyone says that tariffs equal inflation, but the historical record seems like it might be saying otherwise. In addition, the Fed's own internal debate may be shifting as well. What does this all mean for Fed policy and financial markets in general in 2026? Let's get into it.
Let's get to the root. We need to find, you know what we need? We really need like a catchphrase to say right before that. Oh man, let's start digging. Food for thought. Think about it. If you have any recommendations, leave a message down below, preferably something with root and or evil.
So much of the consensus view throughout 2025 has been that increased tariffs mean increased prices, mean increased inflation. Seems pretty straightforward. But recently, Scott Bessent, on one of the latest All In podcasts, he highlighted a recent study from the San Francisco Fed that kind of challenges that view.
Part of it was just anything the president does must be wrong. Part of it was a failure of imagination. And there's some very good studies coming out now that are showing why everyone has been wrong. That the measurement problems on the increase in goods prices. There's a study from, not a friend of the administration, the San Francisco Fed, with 150 years of data, I would refer everyone to that shows that tariffs do not cause inflation, that they're actually disinflationary. So has anybody read that study?
Scott?
Yeah, that's a pretty big deal. I mean, this is like undermining our whole sort of, economic understanding of how tariffs affect the economy. Like it's kind of in my understanding, you could either take two sides of it. One is prices go up. So from a monetary policy perspective, that means you want to increase rates. You want to be hawkish against inflation. But then the other half is inflation or tariffs could slow down the economy, at which point you want to have rates to go down. So this is, I think, another example I remember when I was studying economics and stuff, too often what you might suspect would happen after a policy change, the exact opposite would happen, because there's just the way in which the factors interact with each other are like reversed. It's very bizarre, but like I remember this is one of the most frustrating things I found in studying economics is that things tend to go in the opposite direction you might initially expect. And then after you observe that, you start like putting, putting these kind of just like reasons why it could be. And they're just like guessing. That's like, economics does not,
the opposite happens.
Call it a real science. It's really not. It's the predictive ability is so bad that you can't even call it like a science. It's so garbage. Mm-hmm. And there are jokes about this with economists where 500 economists show up at a conference and there are 700 theories of what happened. It's because because they don't know.
Wall Street itself, you see the same exact thing. It's that time of year right now, end of the year. Everyone's been writing about, what to expect in 2026. As of today, everyone's very optimistic. Getting into the easing cycle, economy seems fundamentally strong. It's going to be a great year. Whereas one of the most obvious ones I remember back at the end of 2022 going into 23, it was just unanimous that 2023 was going to be a very tough year, probably going to see a recession because of the rate increases, and just none of it happened. Everything did really well that year. So I'm even getting a little nervous right now. Since everyone thinks it's going to be really good, it's like it could very well mean the opposite.
That's a funny point. There's there's so many good examples. One of I'll say two things. One is there's like a really great, it's almost like a GIF. It's just like a really short video whereby they showed where over time, how expectations for inflation were going to change. This was back when it started to take off and everyone thought it'd be transitory. And then where it actually went. And you can just see how the expectations were wrong just consistently for like months and months and like a year. Like nobody knew what was going to happen to this. That really struck home with like just how these expectations are just plucked out of nowhere. You really don't know. The second thing I'll mention is when something already happened and you're looking at a graph from the past and like some line chart that sort of bounces around, how easy it is and how much people just want to put a story to it and everything just sounds reasonable after it already happened. This was obvious to me when like I had a professor when I was studying finance, getting the master's at Columbia at SIPA. This guy Richard Robb, really liked him. Great professor, like hedge fund guy. He just would click a button in Excel, would just do some random numbers and create like just a random walk. And he would like just kind of he would just click it, a random walk would show up, and he would like kind of describe like the story behind it. And it was everything he said sounded reasonable, but it's just a bunch of random numbers. That really like struck home. That left that was a good lesson. We want to ascribe a story and reasons to stuff, but like we really don't. I mean, let's be humble.
Yeah, the danger of overinterpreting data and statistics. It reminds me of that one chart from like linear regression. I think it's called like Abscon's quartet. Do you know what this is? Where basically it shows 4 different scatter plots that are like extraordinarily different, but they all have the same regression formula and therefore interpretation and all this stuff.
Oh, interesting. No, I did not know about that. But yeah, that's a good point. That's a good one. Yeah, throw that up there. The differences between like, wisdom and intelligence is like wisdom sort of knows the limits of its own intelligence. You're sort of aware of what you're very much aware, and you feel consciously what you don't know. So like people who might be like super intelligent and look at those graphs and explain like what's happening will really believe it, even though in fact like the wise would look at that and say, we don't really know.
Right. Know what you don't know, and also be aware that you don't know what you don't know.
You've never seen really like an arrogant, there's not too many arrogant wise people, for instance. It just doesn't work. Some humility. You are extremely aware of the limits of your own intelligence.
Was that other quote, like again, back to philosophy here, is it Bertrand Russell or something? It's like the problem is that all the fools are so happy to endlessly talk, and the wise people are never talk because they're weighed down with doubt constantly.
Yeah, confidence and conviction are also
anyway.
Anyway.
Enough
show me this paper.
Philosophy here. But yeah, so this is the San Francisco paper Fed. San Francisco Fed paper. And
I understood what you meant.
Not to go over the whole thing here, but they basically take data from the past 150 years from the UK, France, and the US. They try to zero in on periods where there's a lot of change in tariff policy. So that's important because there's a lot of time whenever, like especially after World War II, tariff policy didn't really change all that much. But especially in like the late 19th century, turn of the 20th century, there was a considerable amount of back and forth in changes in tariff policy. And one of the initial observations they make actually is that a lot of the changes you see around tariff policy, it might even just be linked to the political cycle and what the current party in power is doing. So there's, even with this, there's like a heavy dose of, you have to read these things carefully for, you don't want to, like we were just saying, you don't want to be too sure about what you're seeing. You don't want to impute meaning where, it's not really quite there even.
Yeah, there was one really good chart in there about, that just overviewed this one. Yeah, this guy. Yeah, just to kind of show where the tariff rate was. Just kind of to your point. And just like the broad theme, and you can see globalization right there take place after, World War II and stuff, and just generally trying to drop tariff rates. But before that, yeah, they were up there. The paper is interesting because it goes through the history, and I think it does so pretty clearly and succinctly in terms of sort of what the pushes and pulls, what the drivers were for the two sides of trying to raise and lower rates. But yeah, you're right. It seemed to be more politically driven as opposed to any sort of external economic shock or something like that.
The best we can do here, though, is take this economic data, take that story that we know, and see how things do or don't line up. So the main study in this that we'll look at next is the effect of changes in those average tariff rates compared to the changes in inflation and the changes in unemployment. All right, so here's what I think is kind of the most instructive visual of kind of the whole paper. On the top panel, the changes between the two in the same year, and then the bottom two show the changes between the same two variables in the year following. If you look at this scatter plot and draw that big black dotted line through it, there seems to be a negative relationship. If you look at the unemployment, there seems to be the opposite relationship.
If that the big black dotted line wasn't there, this wouldn't look as clear.
Yeah.
But yeah, it looks like, if you
the black
raise
dotted line's
tariffs,
doing a lot of work there.
Inflation goes down. Yeah, it's earning its keep. But in this one, what they're kind of suggesting is there seems to be kind of a correlation between increasing tariffs and actually deflation. And then the opposite with unemployment. So increased tariffs, unemployment goes up.
The majority of the points are all heavily clustered in the center. And if anything, that kind of would be more suggestive of kind of like no relationship.
No relationship, yeah. They're clustered around zero on both halves. Like oftentimes you don't get these like huge, massive change in tariffs. They're usually like 1%, 2%. It's just around zero. And then same thing with inflation is always kind of hovering. Although that said, on the few times where it does go like a huge change in the tariff, they are meaningfully below zero too.
Right. And that's where the kind of historical interpretation would probably help. To me, this is doing like really two things. It's both challenging the assumption that an increase in tariffs leads to a persistent increase in inflation, number one. But also it's kind of showing that, maybe there's no relationship. Like the fit here, it looks to be decreasing. But again, like we said, they're heavily clustered. This might be mostly noise.
Right. It definitely doesn't, it certainly doesn't support the current theory, which is that increased tariff, increase inflation.
Now, the year ahead, though, is a little more interesting, I think. I think the most important quality, though, is that you're still heavily clustered around zero on both axes, and that's really tough to say much of anything about. But you do have a little more dispersion around some of the more extreme points, kind of suggesting that with a change in tariffs, you need about a year for them to settle in to see changes within the underlying inflation rate.
Yeah. Although there are definitely a lot more of these ones in the next year. Definitely a lot more. If you go negative with the tariff change, so you go negative, you go deflation. You know what I mean? I don't know what was going on like down here. There's a -5 change in tariff percentage point, but then like a -10 change in inflation. There's a couple of those. I think what they were trying to do, like the reason why there's a red politically motivated, didn't they try to pull that out because they said politically motivated changes are probably completely outside of the business cycle? So they kind of put more weight to those as to an example of something that's just independent. I mean, in that sense, if you only look at the red, then yeah, it's more along that line, showing a negative correlation. If you only looked at the politically motivated, supposedly our interpretation being a independent, sort of more independent, less noisy.
So that's the inflation side. Over on unemployment, to me, you see the opposite kind of in both directions. So number one, you see a different relationship. You see a positive correlation here. You don't see quite as much clustering around the center there. So you see more dispersion in the underlying data, which statistically suggests that you could have a stronger statistical fit of the data. Once you move to the year ahead change in unemployment, things seem to break down again. But just like with inflation, it doesn't, you can kind of squint a little bit and still see a positive relationship. You're not seeing a super obviously negative relationship, certainly, but it's definitely less clear in the year ahead from the unemployment side. Whereas for the inflation side, it seems more clear on the year ahead.
Yeah, so draw the line between this and what the Fed people are thinking and talking about. I mean, basically, I guess just calling into question their assumptions. Let's just revisit our assumptions. For the longest time, Powell was up there talking about, tariff. We're looking for the inflation coming from the tariffs. Looking for the inflation coming from the tariffs. And now maybe it's like, oh, well, it's not going to come because that's not how it typically in the path impacts the economy. Usually it more raises unemployment as opposed to raising inflation. And if that's the case, then their course is the wrong one. They should be cutting rates more than they have. I mean, you can imagine if
Exactly.
they adopted this perspective, if people had been conditioned to more readily adopt the perspective that tariffs lead to unemployment, tariff is unemployment, tariff is unemployment. Then once Trump came out and said, I'm announcing all these tariffs, then people are up in arms about, oh, watch out for employment, got to cut. So it's a big deal. It flips. I mean, it's a total flip.
All right, so let's see what the Fed is thinking about this. The Fed released their meeting minutes from their most recent policy meeting in December, where they just cut rates again for the third consecutive meeting in a row. Throughout the first half of the year, they were very resistant to doing so. But of course, now the big question is, what are their views over the coming year? So one of the things they're calling out on the first page here up front is that really near-term inflation expectations have been changing somewhat. So it says, due to lower energy prices, as well as a reassessment by some market participants of the likely effect of tariffs on near-term inflation. So that's saying right up front that some views are changing, even in the short-term view of inflation, the likely effects.
That is a big deal. They wrote that right in the minutes. Economic, what do they say? The winner, history is written by the winner, and economic history is written by central bankers. And these are, a bunch of central bankers. You can see at the very top sort of changing, their tone as to what inflation means.
So on the FOMC's views themselves on the economy over the coming year, risks around the forecast for employment and real GDP growth continue to be seen as skewed to the downside. And this is the key point here, I think, as softening labor market conditions and elevated economic uncertainty raise the risk of a sharper than expected weakening in the economy. So there's some shift towards the unemployment side of the mandate.
Wasn't the fear of the labor market thing had to do with the recession? Were there a lot of recession talks for the longest time?
So you mean like recently, within the past few months?
Yeah, like the back and forth between, is this more of, are we more fearful about inflation or the unemployment? I thought the unemployment was really on the back of expected recession or something. Or am I just making that up? Like, aren't there, don't they sort of track recession expectations?
The short answer is yes, they do have recession probability models, but they're not really cited that much in these official communication. Now, people ask them a lot about it, but at least in the meeting minutes here, we can see a lot of the discussion focuses on that economic data itself. And then on inflation specifically, then they go on to say risks around the inflation forecast continue to be seen as skewed to the upside, so they're still concerned about it. Upward pressure on inflation this year and the next, after more than 4 years of inflation being above 2%, raising the possibility that inflation would prove to be more persistent than the staff expected. But I guess to my point, it's not being quite as clearly highlighted that tariffs are going to be the main cause of this. I guess just to make things a little more concrete, what does the latest data say about inflation and unemployment? The past two CPI and non-farm payroll numbers both surprised to the downside. Now, there's some caveats around this because this is also over the period that started to cross the government shutdown. So both of these data sets are actually done on a 2-month basis. So there's a bit of a gap in the data. So here we can see the latest CPI print from November. So we see right up front these month-over-month levels. They just say straight out they're not available throughout the majority of 2025. From April up until September, we saw inflation gradually ticking upward. But in this 2 months between September and November, we see a decidedly lower shift, both in the headline, the blue line here, and in the core reading. On the other side, the employment data, it's telling the opposite story. The monthly job growth numbers, they were able to give an estimate for October, which was a pretty big decrease, followed by November, kind of a modest increase. But just looking at the overall trend here, throughout 2025 compared to 2024, there appears to be a pretty clear weakening in monthly job growth. And so we see that pretty clearly as well through the unemployment rate. We are missing that value altogether for October, but it seems to be on the same trend that it's been gradually taking higher since about June of earlier this year. So taking those two together, we've seen inflation both come down, and actually quite a bit more than people were expecting it to, and the unemployment rate tick upward. So in the context of that San Francisco Fed paper, it seems to suggest that the better policy move right now would be to lean into cutting rates more, to proactively head off a sharper decline within the labor market and GDP growth.
Right. Yeah, I can see that. It's very clear.
Naturally, that's raises the question, what is the Fed to do next? They've been in this posture for a very long time now where they've been trying to avoid a big mistake, but we're starting to see a shift in those balance of risks recently between inflation and the labor market. So there's kind of three paths that the Fed could go from here. The first, I think, would be the most consistent with its 2025 view, but like we said, that might be changing from here, is if they continue to emphasize the risks implied by inflation, decide to not cut, and then the labor market deteriorates very quickly. The Fed's probably going to be looking at the same policy mistake. I'm sure Trump's going to want to fire the head again, whoever it may be at that time, if this comes to pass. The second path is that if they lean a little too far into anxiety about the labor market, is if they keep cutting more, maybe even a little more aggressively than they initially thought they would, you could have a reacceleration of inflation while you're trying to defend the labor market. And then the third, kind of the happy medium between the two, that is to continually, gradually cutting in line with gently weakening labor market and falling inflation expectations.
I mean, if you were to ask Powell what they thought, it would just be like, oh, we'll just keep looking at data and make the decision. Luckily, it's not like you can kind of step your foot across two paths, I think, a little bit. And just this is sort of like what a story you could say after everything, after it all passes. But like month to month, meeting to meeting, you're just kind of like walking the line. You have any predictions?
So I'm firmly in the we need to protect the labor market at this point. We're not seeing drastic increases to inflation. In fact, we're seeing it start to come down again. And the other big wild card, of course, is that Powell's term as chair is going to be up in May, and Trump is certainly going to put up someone else who is going to be leaning more towards cutting rates. And in fact, we've talked about this in the past. That's probably most of the candidates' main selling point about how much they're going to cut rates.
Here, let me make the case for why I should be the next head of the Federal Reserve. Cut them all. Cut it as much as possible. Hey, just blew onto the scene here. We need to cut rates now. Obviously, no. But I heard Myron sort of answer questions at the when he went to Columbia during that speech, and yeah, he definitely did not sound like a politician then. Then he really did sound like he knew what he was talking about. My impression of him changed, I'd say, after watching that for like 20-30 minutes. Really? I thought he just sounded initially it did. Initially, he sounded, whenever I listened to those MSNBC interviews or whatever, he really did sound like a politician. But when he sat down across, from Clarida, I think he was speaking to Clarida, that was like, he sounded like a central banker. He really seemed like he knew what he was talking about.
One of his main points is that there's some issues with how inflation is measured itself. Maybe inflation really isn't as high as we thought it's been.
A notable aspect of core services inflation is that not all components are measured from directly observed transactions. Many services components in this index are imputed in various ways and do not capture information about supply-demand imbalances that are relevant for monetary policy. A prime example is portfolio management services, which have contributed a quarter point to core PCE inflation in the last year, well above their long-run average. The Bureau of Economic Analysis measures portfolio management costs based on overall revenues generated by asset managers. If the stock market goes up and boosts assets under management, revenues move in tandem since they are typically a fixed percentage fee of assets. What ought to be recorded as an increased quantity of services consumed is instead recorded as an increased prices. There may, for national accounting purposes, be a good reason for doing it this way. But for monetary policy purposes, there is none, and it would be foolish of us to chase statistical quirks rather than focus on actual consumer prices. Remarkably, long-run trends in the asset management industry point towards fee compression, indicating trend deflation.
He also talks about housing quite a bit, where that was one of the things in the latest CPI report. People were very surprised at, number one, how high the headline number fell compared to what people thought, but also specifically the rents contribution to the overall number was far lower than people expected. And I'll also, last thing I'll say is that, to Myron's point, as a politician, that's one of the things that he's really been pounding the table about. Housing is such a big contributor to the CPI number. Myron's argument was that over the past 4 years, with millions of more people coming into the country, that's naturally going to have an inflationary effect on the cost of rents. And now we're seeing just the opposite. Those are two big things that he's been talking about for a while now, which, I think this just gives us even more evidence that inflation might not be as bad as it's been made out to be, at least, certainly for the past few months now.
Yeah. Anyone who's willing to sort of get into the methodology of things, like how they're calculated, has my ear as someone who's probably thoughtful. Because I think that's a lot more happens in there than I think people realize. And, he's willing to go in there and start seeing how these numbers are actually calculated and if that makes sense. Because at every one of these decisions in which they decide to weigh one thing this way or that or how much, there's always quite a long debate, and it could go either way. And how often they're revisited, these assumptions or the weightings or the methodology, it's really not that often, I think. And it should. That was certainly one of the things that he raised and talked about that would have given me and changed my impression of him as someone who's, less from the politician side and more to be more thoughtful. So, props to him. I got a evolving opinion of that guy.
It's such a shame now that his term's just about up now, so we won't be seeing him quite as much anymore.
You don't think they'll put him back in?
I think that Trump probably would renominate him again, but there's a issue of timing right now. Everyone sees that January seat opening up where Myron is right now to be replaced by the likely Fed chair pick. So it's probably going to be, so if it's not Christopher Waller, let's say, as his Fed chair pick, that new FOMC member is probably going to go onto the board in January. If Powell decides to step down in May, then, that would be another seat. Possibly he gets renominated then. But that's also the big wild card. It's really not clear if Powell's going to choose to stick around.
What do you mean Powell chooses to stick around? Is that it's not his decision?
The chair term doesn't line up with the FOMC board member term. So he's out as chair in May 2026, but I think his seat on the board of governor is up in 2028 at some point, 2 years after or so. So Fed chairs, just by tradition, they typically leave altogether once their term is done. But he doesn't have to. He could choose to stay around for 2 more years if he wanted. People say he might choose to do that, go against the norm if he's really concerned about what Trump's doing to the Fed or something like that. I think those fears are a bit overblown, but we'll see.
Interesting. No, good stuff. Exciting times.
Exciting times. We got a good 2026 ahead of us here.
Lined up. Yeah.
Lots of rate
Happy
cuts
New Year.
coming.
Happy New Year. This will probably be posted after the New Year. So Happy New Year.
Yep. Happy New
Although
Year.
we're recording on the 30th. Exciting 2025. Looking forward to 2026. Let's get it.
And with that, this has been the Root of All Evil podcast. Thanks for tuning in. I'm Joe.
I'm Luke.
We'll see you next time.
Take care. Bye.